It doesn't have to exist. What are you doing in this class? Usually you come to corporate finance class, right?
You were gone from the
Yeah.
Okay. Yeah.
What? Lots of empty seats, right? My unit economics workout added numbers, no cost to me, so. Go out and pull out a few people off the street if you want, right? Maybe a few people who are demonstrating in Washington Square Park, ask them whether you want to sit in evaluation class. Yeah. Might not be a great idea, but you could try. Okay, folks, welcome to the second to last session of this class. Couple of reminders. One is your project, in case I haven't mentioned this before, is due on Monday by 5 o'clock. I think I have, but just in case you're still confused. And I'd like to have your numbers as soon as you're ready. Clearly you have to wait until after Friday to get the close of trading price. But if you have the numbers ready, put them in on Friday. If you have to do it Saturday, get it on. But I need them by Sunday at a reasonable time, maybe midnight. To get them into the slides for Monday. The later you do this, the more difficult my life becomes because it compresses my time. And it's not a lot of numbers. It's 5 numbers for your company. What's your intrinsic value? What's your pricing? If there's an option, what's your option value? What's the current price? And what's your recommendation, right? 5 things. And what I will do on Monday is actually vomit back. That's a terrible word, but kind of disgorge what you found back to you. This is the percent of companies that you found undervalued. This is the most undervalued. This is the most overvalued. And I'll give you a sense of history. I mean, obviously, having taught this class for 40 years, I know what prior buy and sell recommendations have done in the years since. So we can think of a quasi-mutual fund we could have created out of class recommendations and how well or badly that fund has done. So today we're going to talk about, sorry, Deep. Oh, I wasn't. Mic is on, so can you guys hear me? Okay, so maybe there's this angle. Right. So today we're going to talk about changing the value of a company. Notice how up till now we've valued companies, right? We've looked at companies as investors and say, what is the value of the company? Today I want to talk about how do you change the value of a company. Now, why might we care about changing the value of a company? Who are the people who are most interested in changing the value? Who run the company, who own the company. So if you're a manager, so if you go to work remember, corporate finance is not just investment banking corporate finance, right? You can go to work at Pfizer, you can go to work at GM, don't, but if you do, you can go to work at Tesla and have Elon as your boss, which is kind of scary. You work at a company, your job is to increase the value of a company. Also remember that if you go into consulting, remember your prime clients are companies. If you're doing your job right, and I'm assuming that that's your intention, what is the purpose of McKinsey coming in? What are they trying to tell a company what to do? Changes they can make that'll make them more valuable companies, right? So we're actually going to, if you're thinking about investing as looking in through a glass bowl at a company and essentially taking the company as giving and valuing it. Today, I'm going to take the bowl off and say, you run the company, what would you change about the company? So I'm going to start that process off today, start the class test by asking you questions about what is it that changes the value of a company? So I'm going to list off a series of actions. And all I want you to tell me is, will it affect the value of the company? Will it increase the value? And if so, how? And to do this, I want you to remember the IT proposition. Wairang, what's the IT proposition? Remember the IT proposition we did in session 2? Anybody remember it?
It doesn't affect the
Cash flows, and it does not affect the risk. It's not worth talking about, right? So remember that proposition. So that's so the first action is a stock split. This morning before I came to class, there was somebody making a big deal on CNBC about how NVIDIA should split its stock. And if it split its stock, it'd become a more valuable company. We know most people on CNBC have no idea what they're talking about. But can a stock split make you a more valuable company? What do you think, Andrew?
no, it doesn't affect the capital.
Does not affect the risk. All it changes is the number of units. So what the heck are they talking about? Remember the value versus pricing thing we talked about? Can a stock split affect the price? Sachi, what do you think?
Yes.
Maybe it'll add liquidity. Maybe you might think this is a good signal. It can affect prices. So today we're going to talk about value versus, but it can't affect value. It might affect the price. Goodwill. Remember we talked about what goodwill is? Goodwill is a plug variable. It essentially allows balance sheets to balance and reflects how much you paid as a market value for a company relative to book value. Until this century, until 2000, if you had goodwill, it got written off automatically over 40 years. You amortize 1/40th each year. Starting in 2000, companies are required to amortize or impair goodwill. What does that mean? Anybody want to tell me what goodwill impairment is? Who does it? Why do they do it? Yes.
They look at the goodwill and basically it's still worth what they paid for.
And who is the they? Usually it's in a group of accountants, they call in KPMG, Deloitte. They come in, they took a look at an acquisition you did 3 years ago, and they say that deal was a bad deal. So impairment, there are about 70% of valuation work at Ernst & Young, Deloitte, KPMG is really what I call show valuations, accounting valuations. And a big chunk of it is goodwill impairment. So, you're spending tens of millions of dollars paying accountants to tell you whether you made a mistake 3 years ago. Impairing goodwill. And this can be billions of dollars, right? You make $1 billion, I've seen impairment of goodwill as high as 25 billion. Can impairment of goodwill affect value? Does it affect the cash flows? It could if it were, impairment of goodwill is a non-cash expense. Nick?
Could affect your taxes.
That's the first question. Can impairing goodwill reduce? If it reduces taxes, the same effect as depreciation, right? It's a non-cash expense. And in fact, impairing goodwill will then be a good thing because now you have $25 billion. I have some bad news for you. Impairment of goodwill is not tax deductible. So if it's not tax deductible, who cares? It doesn't affect the risk of the company. You're saying, but it tells you your company overpaid 3 years ago. The current risk is the current risk. So you're saying, why are we spending tens of millions of dollars doing something that doesn't affect value? Because it gives jobs for accountants and they are people too, and they need jobs. So I will reserve my empathy for them for this moment. But if some accountant says, look, I impaired goodwill, don't put them on a pedestal. Say, I am so sorry for you that you had to spend so many days doing something that nobody cares about. Which is effectively what it is. What about changing your, remember, when you do depreciation, you can either do straight line depreciation or accelerated depreciation. The only difference is you depreciate the same amount. With accelerated depreciation, you take more upfront. Sometimes companies change their depreciation method just in their reporting books. You think, why would they do that? Why do you think they do that, Sebastian? I would love to think analysts are that deep, right? If usually when there's a change in the reporting books, will they switch from straight line to accelerated or accelerated to straight line? Yes.
Straight line.
And tell me why that, what that does.
It's saving you taxes.
It's only in your reporting books, right? Not in your tax. it'll actually increase your earnings, right? You replace a higher number with a lower number in depreciation, your earnings looks like it goes up. And so when you do the earnings call, you say, our earnings per share were 6 cents higher than analysts expected. But you didn't change the tax books. You're still paying the same taxes. Your cash flows didn't change. Your risk didn't change. But could you fool some of the people some of the time? Absolutely. For about 3 hours before people take a closer look at that. That's what you did? Because you have to reveal it. Right? No effect on value. How about issuing tracking? You heard of tracking stock? Became a phenomenon in the 1990s. The New York Times issued tracking stock. You think, what the heck is that? They created a part of the New York Times that they call NewYorkTimes.com. So peak of the .com boom. They issued tracking stock against it to investors. And as an investor in that, you got no control over how the online business. So basically, they had an online business already. Nothing about the business changes. You get no power over the business. They collect your money. So issuing tracking stock, you're really not creating a separate company. You're just collecting money on a portion of your business that's already there, that's going to continue to be there. What effect does it have in value? Absolutely nothing. So why are they doing it? The peak of the .com boom. People will buy anything with .com attached to it. So you were taking advantage of a pricing screw up. I will predict in the next decade, you'll have a lot of companies add .ai to their names. Kroger AI. So what the heck does that mean? Grocery store, but we have AI. Don't know. There must be something good. We'll double your price. It has no effect on value, but it can affect your price. Sebastian? You could bring in the cash, and then what you do with the cash might impact your value. So maybe there's a cash, but you're not actually, after that initial run, doing much with that cash, but you just have this higher price on your company because you have stock and you own 100% of the tracking stock company. So it's not even that they want to increase the cash coming in, is they want to give the perception of we're a more valuable company because our tracking stock made us more valuable.
Are the people falling for this individuals or?
Do you think so? Who do you think falls for this? Everybody. If you think, there's this old divide every time especially with Asian business interviews, they say, is it retail investors or is it institutional investors? You know why they separate the two, right? Institutional investors are wise. They're informed. Retail investors, these the people who don't really know what they're doing. They're shallow. Guess what? The worst sheep of all are institutional investors. They're the first ones to jump on the bandwagon. So I think it's across the board. Eventually the glow wears off, but it's just across the board. Yes? You could. You could. It depends on, Ponzi schemes are illegal. These are legal, right? So think of it as a legal Ponzi scheme because they're actually technically they're revealing that this is a tracking stock. You walked in with open eyes. So I'm not going to come and protect you. An actual Ponzi scheme, but remember, every scam is like a tango. You need the scammer and the scammed, and they're both in this together, right? No scam can emerge with just the scammer. So when people say there's a scam, I say, but you were the scammed. Why were you part of the scam? Because you were greedy. And when you're greedy, you tend to put blinders on and you don't ask the questions. So second question. You've come out of Stern. You have a job, but you get a job offer by email. You're going to be the CEO of a new company. It's amazing. You jump. It's a 4-business company. These are the 4 businesses. And you're planning on selling off one of these businesses. So you can take a look at the differences. I've given you the return capital and cost of capital. Which of these 4 businesses would you sell? Andrew? Does everybody want to jump into D? And this is the problem with business school. Is we talk about good and bad businesses all the way through school. And you're right, D is the worst business and you want to sell it. But let me ask you, Sachi, what's the effect of selling a business on for your shareholder value? You've sold the bad business, but what do I have to compare what you sold it for two to make a decision on whether it's going to be good for me or bad for me. I get a price for it, right? If I sell a bad business for nothing, I'm actually lowering my value as a company. Without the price in here, you can't even make a decision. And I'll make a prediction. The business you probably can sell at a price higher than value is not your worst business. It's probably going to be your best business. It cuts against the grain, right? You're saying you're taught to get rid of bad businesses. That's a terrible piece of advice. Because getting rid of bad businesses for well below what it's worth is a terrible decision. And getting rid of good businesses for well above what they're worth is actually a good decision. But as a CEO, you want to have great growth businesses. You don't want terrible businesses. I can see why CEOs do it. But this is something we're going to come back to about divesting and effect on value. One final question. This, I teach a corporate finance class where we talked about dividends and buybacks last week. And I'm going to focus specifically on buybacks. And I got a call from a CFO. The CFO was a student of mine 20 years ago. And he said, remember me? I lied and said, yes, you stick out in my memory like the only person I've ever taught. Now, I think it went along, right? And I was looking up his grades while he was calling me because I have every Excel spreadsheet with all the grades going back to 1989. He wasn't that good. I was like a B plus student. And the plus was, I think, more a sympathy plus than an actual plus. It's close, then I pushed him over the edge. So he said, look, now as a company, we're planning to do buybacks. And we're trying to compare the NPV of the buyback to an NPV of projects we can take. You know how in traditional capital budgeting, you can put the NPV, look at the investment, you can look at the cash flows. And he said, we believe our stock is significantly undervalued. And if we buy the stock at that lower number, so if the value is 40 and I buy it at 25, that's like a positive net present value project, right? Whenever people ask you the question, right, they want you to agree with them. That's kind of a message. And I said, wrong. Tell me why that buyback is not, why you can't compare the NPV on a capital budgeting project to this NPV of buying your shares back at a lower price. Sebastian?
Buy back shares, you're assuming that the price is not going to go up to whatever the value.
But let's say he's right, that it is in fact undervalued. It's true, you could be right about but let's say that he's right about the value, that there is going to be an adjustment. When you buy shares back at a lower price, now, when you take a project with a positive net present value, you are creating value for the company. Company gets more valuable. When you buy shares back at less than what you should pay, you're transferring value. You see where the value transfer is? It's going from those people who sell their shares back to the shareholders who remain in the company. And you might say, that's my loyalty. I want to make the loyal shareholders who stay in and I'm okay with that. But this has nothing to do with value creation. It's value transfer from those people who sold their shares back to those people who remain. Dividends and buybacks cannot create value. So take that off the table. You cannot create value, but you can transfer value. And you might, if you do that, be open about it. That's why we're doing it, is we want to, make our loyal shareholders who stay with the company become wealthier, because we want to transfer wealth from those who want to sell their shares. So all of those will be grist for the mill today. So I'm going to, go ahead.
So on the previous slide, we talked about not selling off the worst business.
Yeah. Because the price of it might already reflect that it's a terrible business, right? So
the counter argument is that not, you're having to maintain this business.
But that's what the return on capital is. Remember, the return on capital is not negative. It was positive. You're just not making enough to cover your cost of capital. So if I took those cash flows you have, let's say the 3% works out to 30 million a year, the 7.5% cost of capital, the present value is still positive, right? And if the price is less than that present value, that's like taking a negative net present value investment. So you're comparing positive cash flows, not as high as they need to be to cover your cost of capital, but you can't get your invested capital back. You're saying, why don't I just shut the business down? Because that's not an option, right? Nobody's going to pay you book value for an airline or a bank that's a terrible bank. So the book value becomes a non-player. It becomes what can I get by shutting this down versus what can I do by running it. Yes, Nick.
In the previous example, if you bought shares at 25 for a buyback and they're worth 40 and you sold it right away, isn't that great value?
Who are you selling it to? Which will be at 25, right? So you'll be just circling around, right? So it's not going to, so this has to be a wealth transfer. This, again, as I said, there's nothing wrong with it. Berkshire Hathaway actually explicitly made that a condition for stock buybacks. We will not buy back stock unless we think the price is less than the value, which is good. It actually disciplines you and says, we're not buying back stock just because, X, Y, and Z is, my peer group is doing it. Let's go back to the M&As. If you were planning to go into M&A, you were thinking about M&A, it was a very depressing class, right? I gave you the bad news. Most acquisitions don't work. I'm going to keep piling on, but then at the end, I'm going to give you a glimmer of hope if you still want to hold on to acquisitions. So I left you with this page. I talked about operating synergies with either lower cost or increased growth. And I started on financial synergies. JP, do you remember the financial synergy that I kind of threw at the end of the class, the one that should not be mentioned, the Voldemort synergy? Anybody remember? So I guess Sachi? Taxes. You think, how can a merger save on tax? I'll give you a few ways. You have a money-making company buy a money-losing company. You see the tax savings, right? You take the losses, pay less in taxes. After you do an acquisition, often accountants come in and revalue your assets. They're allowed to do it. It's called purchase price allocation. And if they push up the values of the assets, you get more depreciation in the future. Potential value created. Or in some countries, the way the law is structured, you can actually get more tax savings after a merger because you might get in Brazil, for instance, there's an item called interest on capital. We are allowed to take the book equity of a company, take a percentage of book equity, claim it as a tax deduction. So if you do an acquisition, the book equity goes up, you actually save more on taxes. You're saying, what's wrong with mentioning it? About 10 years ago, Pfizer was planning to merge with Allergan. Allergan is a Ireland-based pharmaceutical company, a UK-based. And after the merger, they were planning to move the entire company's headquarters, Pfizer's headquarters, I think, are in New York, to the UK. You know why they were doing it? In 2015, when they were talking about this, the US had a very strange tax law, the 2017 tax reform, which is if you're a US company, you are required to pay US corporate taxes on income generated anywhere in the world. So if you earn money in Hong Kong, where your corporate tax rate is 15%, you had to pay the 15%. And at that time, US corporate taxes were 40%. You had to pay an extra 25%, but only when the cash was sent back. I don't know what legislators think will happen when they write laws like this. So when the money comes back to the US, we'll charge you the extra 25%. So if I wrote that law and you're a company, you earn a lot of money in Hong Kong, what are you going to do? Leave it there. It was called trapped cash. At its peak, Apple had almost a $200 billion trapped cash balance. And your first reaction was, trapped by whom? Trapped by the tax law. So in 2015, Pfizer said, we're tired of playing this stupid global tax game. If we combine with Allergan and we move to the UK, we become a UK-based company. And the UK has a more sensible tax law. You pay taxes wherever you make the income. And that's it. So they did this. Everybody knew this was the case. And then the CEO of Pfizer gets on CNBC, and the CNBC anchor says, why did you do this? And I remember, I was watching, and he says, oh, to save taxes. And I whacked my head, and I said, what were you thinking? Because he gets off CNBC, and all hell breaks loose. It's a big company. It's announced on CNBC that it's doing the merger to pay less in taxes. Senators get up, I think the same day or the day after, this is terrible. It's a violation of US tax law. So 2 weeks later, Pfizer had to give up on this because it was too much backlash. So if you're going to do a merger motivated by taxes and you're on CNBC and the anchor says, why are you doing this? Remember all your strategy class buzzwords, bring them all out, right? Hey, It's strategic. Throw that word in there. You know, we're a global company and we think globally. What does it matter geographically where we are? We could be in Star Wars universe for all it matters. Do everything to distract. Take attention from every word except taxes. So if taxes are your reason for doing a merger, just stay quiet, do the merger, pay less in taxes, don't boast about it. Let it flow through to your investors and move on. Here's the second financial synergy. Two companies that by themselves can't borrow much money. It's not because they don't want to, but they're small companies. You combine, you become a larger, more stable company and now able to borrow money that could potentially increase value. Why? Through a lower cost of capital, tax benefits again. And third, you acquire another company purely for diversification reasons. What have you been taught through business school? That when a company acquires another company only for diversification, it shouldn't. And why? Because it's not even investors in diversified. So if you plan to do an acquisition for a diversification, I can call my broker and buy the same company. And how much of a premium over the price do you usually pay when you go through your broker? If you've been going through a broker where you're paying a 20% premium over the price, I'd like to be a broker instead. I'll just take 15% off. The answer is when you buy the shares yourself, you don't pay a cent in premium. So diversification is a terrible reason for a public company going out and doing an acquisition. But remember we talked about private businesses? Your order of a private business is not diversified. What do you use as your beta to get your cost of equity? A total beta. Wasn't that long ago, right? Third quiz, right? Second. And how do you get a third? You take the market beta and you divide by the correlation between what you own and the market. Do you see why private companies might benefit by diversifying? Because if you're a private company and you buy another company in a different business, your correlation with the market goes up because a combined company. And if you keep doing this, you could actually end up with what looks like almost a mutual fund. You're in 16 businesses. Your correlation goes towards one. Your market beta has become your total beta. There goes your diversification discount that you used to pay. If you get a chance, take a look at almost every family group in Asia and look at what businesses they're in. You know what the answer is? They're in everything. And it was a survival mechanism because until 30 years ago, these were all privately owned, family-owned companies. They diversified not because they wanted to be mutual funds, because the way in which you can remove the diversification. So I'm going to give you the template for valuing synergy, and it's a very straightforward one. To value synergy, you have to start by valuing the target company and the acquiring company separately as standalone companies. You cannot value synergy by just valuing the target company. So the first dead giveaway that bankers don't value synergy is when they value just the target company. You need to bring in the acquiring company. So that's a status quo. Existing companies, value them as is. Second step, just add the two numbers up. The nice thing about present values, they're additive. So if I value the first company at 100 billion, the second company at 50 billion, I add the two. You're saying, what is it going to tell me? It's going to give me the value of the combined company if there's no synergy. Step 3, you can throw everything but the kitchen sink in where you think synergy, lower cost, higher growth. Go to town. Tell me all your synergies. I'm going to build them in step 3. I'm going to value the combined company with the synergies built in. And guess what I should find? The value that I get in step 3 should be much greater than the value that I got by adding the two numbers. That difference is the value of synergy. Let's try this out. So about 20 years ago, huge merger, largest consumer product company in the world, Procter & Gamble, buys the 6th largest consumer product company, Gillette, in this huge merger. And talk of synergy filled the air. So I wanted to value synergy. So in the second column, I have the value of Procter & Gamble standing alone. So I took their financials, think of it running it through the FCFF simple Ginzu spreadsheet, you come up with the value, 221 billion. Then you take Gillette, you valued standing alone, you come up with 60 billion. Then I added the two numbers. And I did call my combined company, Procter & Gamble Gillette. I thought Piglet would be a good name. That's not the name they chose to have. So just adding the two companies, you come up with a combined value of 281 billion. That gives me my starting point. And then I took what managers told me they could pull off, and I assumed they could do it instantaneously. Is that an optimistic view of the world? When managers tell you they cut 250 million, they'll probably cut 200 million. Think of this as the upper limit on synergy. I said, okay, I trust you. And not only that, I trust you can do it overnight, which is really optimistic. So how does that show up? The $250 million expenses being reduced shows up directly in my operating income. You're saying, but why is it less than 250 million? That's my pre-tax savings. After taxes, it works out at that time. So basically, my operating income is going to increase if they can cut costs. They also talked about a slightly higher growth rate. You're saying, why slightly higher? You're the largest consumer product company in the world. You'd buy the 6th largest. You're not going to increase your growth rate by 10%. You're both too big for that. To increase the growth rate by 1%. Doesn't sound like much, but that 1% was like $3 billion in year one. So basically, it's a big increase. With those changes put in, the value that I got for the equity was $298 billion. There's a canard that in finance, we don't think synergy is worth money. That's not true. The difference between those two values gives me a value of synergy. This is a good merger, right? So if you're Procter & Gamble shareholders, are you happy? What have I not? Don't be too quick to say you're happy, because what have I not told you? Oh, no, forget the investment bank. Don't blame the bankers. They're just doing your bidding, right? The price you paid, right? I've computed the value of synergy. I haven't told you how much of a premium they paid. They paid a $25 billion premium. And then we wonder why so many acquisitions don't pay off. You take something worth 17 billion, best case scenario, because probably worth less than that. You pay 25 billion. How the heck do your shareholders get any of the value? Okay. And of course, if you have to wait 2 years to get the 17 billion, because it takes a while for cost, you know what you'll have to do, right? Take the 17 billion, discount it back 2 years at what rate? Combined companies cost of capital, because the combined, you're getting it at this stage. When I ask you what the discount rate is, all you have to do is think through what are the cash flows, where's the risk? So that's the problem with synergies. Not that it doesn't exist, but that people just pay whatever they feel like paying. Now, the second example of synergy is much more focused. This was when Best Buy was actually a growing brick and mortar. You've been in a Best Buy, right? So this is when it's growing. It's now facing all kinds of brick and mortar troubles, but this was when it's growing. And was planning to buy a company called Zenith. How many people in this class have actually heard that name, Zenith? JP, what are they? It was actually the original TV makers. In the 1950s, we walked into a US home and you looked at it, it was a very well-known TV brand. The fact that most of you haven't heard of the brand tells you something about where it is now. If you walked into a Best Buy and you actually saw Zenith TV, you're saying, what is that? I see Samsungs, I see Sonys, and Zenith. So this was a company that had lost its brand name. Nobody was buying its product, but it had one big asset. You know what it was? They'd lost a lot of money for a long time. When that is your only asset, you're in deep trouble. They had a big NOL, a net operating loss of $2 billion. So let's say you're Best Buy, you're thinking of buying Zenith just for the tax benefit. Your tax rate is 36%. Let's start with the easy question. What's the value of Zenith to you? How would you value that? 36% of 2 billion, which is 720 million, right? What if you have, but remember, the government doesn't mail you a check for 720 million. You need taxable income to be able to claim this tax benefit. What if only $500 million in taxable income each year for the next one?
500 divided by your combined cost of capital plus.
No. Don't make life more complicated than it has to be, right? 500 million each year, which means you got to, if you have 2 billion, it'll take you 4 years. Where you get 180 million you get the same 720 million, but 180 million every year for the next 4 years. You ready for the next question? I need to discount it. What discount rate should I use? By now you know the drill. What do you have to do to ask it? Where is the risk that I will not get the tax benefit? It's not coming from not knowing the NOL. It's 2 billion. You know exactly what it is. So that's not the problem. It's not coming from Zenith having income, because that's not. So what is it? What's your one uncertain variable here, Sachi? That's a good point, but that, let's suppose that's not the issue. Best Buy's taxable income, I mean, I gave you an expected taxable income, so you'd be using Best Buy's cost of capital or cost of equity, because it's taxable income, it could be after interest expenses, to discount those tax benefits. So valuing synergy is not difficult once you become explicit about it. But the problem is managers don't like to be explicit about synergy because it lets them pay whatever they want to. So at this stage, I am struggling, right? Remember, I started by giving you this target company with 60 million. All of this has been trying to get you to pay more than 60 million. So I tried to get you to use the acquiring company's cost of discount rates, said no. Then I tried to get you to use the cost of debt of the acquiring company. The fact that you said no to that. Then I said, what about a 20% control premium? And you said, no, I'm not a banker. Then I said, how about synergy? And I can't find any. And you say, okay. At this stage, I say, forget this DCF stuff. And then you look at buzzwords, basically that's what it is. They're trying to pay you more. So I said, okay, forget this DCF stuff. But let's do a pricing. As I said, up at the start of pricing, there's nothing wrong with pricing. So I'm the banker again. I say, the 60 million you computed, that's some perpetual growth model. We don't use that here. But other people in this business are paying 5 times EBIT for companies. And I show you a table of transaction multiple. Because with pricing, you always need a peer group, right? And I show you a table of transaction multiples. What does that mean? Transaction multiples. I'm sorry? Basically, I focus rather than on the entire sector, which is what we do for pricing. I look at a subset of companies that have been acquired and say, in these acquisitions, people paid 5 times EBIT. Let's stop there. Statistically, there's nothing wrong with pricing and nothing wrong with using a peer group, but statistically, because it's a statistical question, you want to avoid bias, right? By creating a subset of companies that were targeted in acquisitions, have I created some bias here? Yeah, we know this control premiums, people pay. So if you're going to do pricing, do an honest pricing. If you're pricing a software company, rather than comparing to other software companies required, you should be looking at all software companies. And pushing it off to year 5 and say, is that going to be okay if I did it in year? No, it doesn't make a difference. You're making a mistake and moving it forward. It's still a mistake. So I say, you know what? You're tough to convince. But this is a good deal. So how do you know? It's going to be accretive. That word should be struck from the English language. Because it's twinned with another word called dilutive. What does it mean when I say this acquisition is going to be accretive? You heard of that word? Yes. Your earnings per share will go up. Let's cut down to the chase, right? So mathematically, I'm going to give you a choice, and you tell me which type of deal is going to be more likely to be accretive. You're a company with a PE ratio of 20, and you're looking at 2 targets, one with a PE ratio of 10, the other with a PE ratio of 30. Which of those companies is going to be accretive and which one is going to be dilutive? Got a 50-50 shot. JP.
30 accretes.
Let's work it out, right? So you pay 30 times earnings, right? So you're paying, so let's say you both have $1. Let's make this very simple. Both have $1 in earnings. Okay, you want to change your answer. So you can see why, right? Just put $1 in earnings for both companies. When you buy a company with a lower PE ratio, you will always have an accretive deal. When you buy a company, it's just the sheer math. So you're telling me anytime I buy a company with the PE ratio lower than mine, I'm getting a good deal. Can you imagine what NVIDIA would be doing right now? You're trading at 800 times earnings. Buy everything. Everything is accretive. It's a stupid distinction. And if I borrow money to buy shares, clearly it's a more accretive deal. So what you're telling me is if I borrow a lot of money and buy stocks with lower PE ratios than mine, they're all good deals. It's nonsense. But it's amazing how many deals are justified and whether it's accretive or dilutive. So when you decide to do pricing, at least do it right. What does that mean? To price a target company, do it the way you priced your company. The fact that it's in an acquisition shouldn't change it. So find a peer group, find a multiple, and you'll have to dance the dance of, did I get the right peer group? But biased samples will yield biased results. So there's nothing wrong with pricing, but make sure you're not building in sampling biases by the way you're creating comparable companies and the multiple you picked. So if there's a lesson here, don't be a lemming. Don't go along because everybody pays 10 times earnings in acquisitions. And definitely don't fall for that word accretion. In fact, that should be a red flag. When a banker says accretive, get up from the table, walk out of the room, right? Because basically that means you've run out of good reasons. You're basically at the bottom of the barrel pulling out words, and you don't even know what those words mean. So at this stage, I am really, really desperate. So you kind of stuck with the 60 million that you came up with the intrinsic valuation. So I say, you know what? I have to tell you something. Remember, you are in the finance group. You're probably pretty high up there. Let's give you you're the deputy managing director of the finance group. And I said, your CEO is the one who came to us. I'm the banker. And he thinks this company is worth 100 million. And you're the last person who's stopping this deal. I think I might have to email your CEO or maybe call him and say, this deal's not going to go through because Wyrong is stopping me from doing the deal because she's stuck with this DCF. And she keeps saying, do you think this might lead you to reassess what you just... I would think that survival instincts will kick in and say, I've taken another look at the numbers, and you know what? The acquiring company's cost of capital is not such a bad idea after all. This might sound outlandish, but I wish I could tell you that acquisitions come from the bottom up. That people at the bottom say, it'd be good to acquire another company to make us stronger. Acquisitions almost always come from the top down. There's actually studies that show that when you look at serial acquirers, remember we talked about serial acquirers at the start of this, that if you look across serial acquirers, one thing they share in common are CEOs who happen to be acquirers. So they move from company to company. The company they go, saying, what kind of CEO does that? I don't know about you, but in high school, did you have these kids around who absolutely were kind of stupid, but thought they knew everything? Overconfident, over ambitious people who are just full of themselves. I wish I could tell you bad things happen to those people, but I have some bad news. Those are exactly the people who rise up the ranks and become CEOs of companies. Bluster and overconfidence can carry you to amazing places. And guess what? If you're an overconfident CEO, you look at Target and say, it could be worth 100 million to us. We could do all kinds of magical things. Remember, you're in magical land anyway with overconfidence. The problem in acquisitions is the decision gets made by somebody up top, and your job then becomes rubber stamping it and making it look like it was due diligence along the way. Now, so it is a reality that you face, that there's a whole ecosystem here. Now, the other argument you'll often hear for acquisitions is if we don't do it, somebody else will. These are called defensive acquisitions. You heard of these? Where you're in a sector, you say, if we don't do this, our competitors will. If the only way you can survive in a business is by doing defensive acquisitions, what does it tell you about the kind of business you're in? Good business or bad business? If you're in a good business, you don't need to do defensive acquisitions. Defensive acquisitions means there's something happening in your business where things are falling apart. My advice to you is find a way getting out of this business. Don't consolidate and become a bigger player because you can survive, but survival is not the end game here. So as you look across companies, you have to think about, what drives this process. And there are lots of egos involved. Lots of people really want the deal to go through. And they've already made up their minds. You're fighting the tide here. And finally, it's not surprising that even people who know the deal's not a good deal, finally say, look, I'm tired of fighting. Throw up my hands and leave. And preemptive or defensive mergers, that's, I think, a sign that the business is deteriorating. Get out of the business. So let me take you through one particularly bad deal to show you how deals get justified and how they unravel. You've all heard of HP, right? When I say Hewlett Packard, what comes to mind here? Well, the fact is David Hewlett and Packard, Hewlett and Packard basically invented the tech business. 1950s, Silicon Valley. If you go to Silicon Valley, there's actually these almost temples to Hewlett and Packard. HP was an amazing company. It actually started in mainframes, smaller mainframes than IBM, transitioned to computers, and then finally it became just a printer company. But it longed to be a growth company again. So over the last 20 years, this is what Hewlett Packard does. Every few years, they do a big acquisition. In corporate life cycle, a big facelift. And you know what happens with facelifts. The face falls again, you do another facelift until you become Joan Rivers and your face gets frozen forever. That can happen to companies as well. So this was actually one of their acquisitions, a company called Autonomy, which is a UK-based software company. They paid $11.1 billion for the company, which was a $5.2 billion premium over the market price. And people were shocked. Even equity research analysts who tend to go along with it said, that's a high price. So at that time, I tried to explain how they got to 11.1 billion. I started with the book value, which before the acquisition was 2.1 billion. Then the accountants came in and they did the purchase price allocation. They managed to push it up to 4.6 billion. The market had an additional premium, 1.3 billion. Then you had 5.2 billion. And how did HP justify it? A synergy in this deal. So I'm going to show you what Leo Apotheker, who was the CEO of HP at the time, told equity research analysts to I'm using exactly his words because I would be embarrassed to actually make up these words. So I want to read exactly what he said. So this is Leo, CEO of HP. He's in front of equity research analysts in New York, and they're very skeptical. This sounds like a high price. And here's what he says. We have a pretty rigorous process inside HP that we follow for all our acquisitions, which is a D.C.F base model. I will wager if somebody in there had asked, can you expand on that? You wouldn't have known it because an A probably had D.C.F, And then he went on. So he said, so this is the journalist filling in, saying, in case he didn't know it, that's in reference to a discounted cash flow model. That settles it, right? If you use a D.C.F, you can't do stupid things. By now, you played enough with that Excel spreadsheet to know that you can make your company worth 2 trillion if you play stupid tricks. Let's keep going though. And we try to make it a very conservative view. I think you missed in DCF what your cash flows are supposed to be. What? Conservative cash flows? No, expected cash flows. But given that he didn't know the expansion of D.C.F, very conservative view. He should have just stopped there, but he kept going. He said, just to make sure everybody understands, Autonomy will be on day one accretive to HP. Now, he's lost the script altogether. Just take it from us. We did the analysis at great length, in great detail, and we paid a very fair price, and you'll get a great return. 3 greats in one sentence? I don't know. The deal goes through. 1 year later, the deal unravels. They had to write the 11.1 billion down to 2.3 billion. It's almost like they wrote it back. And this was, when it happened, my reaction was, that's a big mistake. Who's losing their jobs? So I decided, I actually wrote a blog post on, I'm going to assign blame here. And I'm going to collect from each of you. So first I said, 4.5 billion, the primary culprit has to be the CEO and all of those bankers who ease the process. I'd like their fees back. What the heck did you get fees for? You got me to pay 11.1 billion. Hey, I think it's fair. If you're Goldman Sachs, you should be returning those fees. There were advisory fees. Second stop, HP did complain that accountants had been cooking the books at Autonomy. I said, okay, accountants do sometimes cook the books. That's, it's worth about, so in this case, if you look at the improprieties, but you can blame the accountants. That's Deloitte. I'd like their fees back as well for the auditing and the accounting fees. Then there was continued after they bought the company, they lost their, half their staff. And I said, this you can't blame on the bankers, the accountants. That's got to be HP's, if you think about the current management, they should be responsible. There are lots of parents for this really bad deal, right? But you know how many of these people actually paid a price? Not one. And that to me is at the heart of the problem. There is no accountability in this process, and there's no accountability. Why would we expect good deals, right? If you do a bad deal and I just let you slide by, you're going to continue to do bad deals. So now I'm going to give you the glimmer of hope if you're an M&A that you might be waiting for. So I'm going to offer you a series of choices, and I want you to think about your odds of creating value with each of these choices. So you're an acquiring company. Are you more likely to create value, as we can get a company for less than what it's worth with control and synergy, as a sole bidder or in a bidding war? No bidder, right? And you'll see. And I'll give you the backing for this, and it's absolutely clear that if you're in a bidding war, you should drop out. Second, would you rather go after public targets, publicly traded companies, or private businesses? Yeah, what's the problem with going after public companies? What do you have to start with and build up? You have to start at the market price, and what's in there? God only knows everything, right? All the good stuff you might be talking about might already be in there. It's much more difficult. It's not impossible, but much more difficult. And I'll show you the evidence to back that up. This is trickier. Would you rather pay with cash or pay with stock? You're too quick to answer that. Why stock? But it's the same premium. So when you say more favorable to whom?
Stock is more favorable to the person who's paying.
Or you're saying you'd rather pay with stock because you don't feel it. Is that always true though? Will it depend on something? Yes, Nick. It depends on whether you think your stock is undervalued or overvalued. Your stock is undervalued, you're actually paying with undervalued currency, right? It's overvalued. And we'll come back to it because you're right. You know, there is a temptation if you feel your stock is overvalued, try to pay with stock. Yes. Well, you added the debt there. No, I didn't bring it in. So you're going to borrow the money to do the acquisition? Are you saying that more debt is always better than less debt? Is it lower your cost of capital? Depends whether you're under levered. So there's a whole layer of other stuff that comes in, right? Would you rather go after a small target, small relative to you, or roughly the same size? Why? You're right. This one, I agree with you. Why?
Like small is more controllable.
So you can make changes quicker. You buy a large company. It's like trying to steer a cruise ship through, change which direction it's going. There's culture wars because you have two different cultures. Mergers of equals versus mergers of unequals. Andrew?
Also the lower cost of capital because not necessarily the intrinsic value, but also because of the rating agencies.
Yeah, I think you might be digging a hole there. I wouldn't go there, right? Because I think you have to require ratings agencies to misrate companies. So there is a possibility that it can happen, but the reality is large companies are just more difficult to change. That's the reason. And synergies and other stuff take longer to establish. Would you rather go for a merger driven by cost synergies or growth synergies? Yes. And if it's easier to quantify, it's also easier to deliver, hold people accountable. So when I combine two retailers and I shut down 150 stores, I can go check, did you do that? Whereas with growth synergies, it's kind of pie in the sky, right? We're going to do this because we'll have these great projects. And you don't tell me how many projects, how do I track it? And that's a purely empirical one, because in theory, you can say, what's the difference? In practice, we'll see what it is. So let's take each of these choices. This is a graph that looks at what happens in a bidding war to the company that wins the bidding war versus the company that loses the bidding war. The way to read this is a terrible graph. It's a very old graph before Excel even allowed you to do great graphs. So basically, if you see a drift up, that means your stock price is going up. That's the date on which the bidding war was, you had a winner and a loser. One of these is the winner's stock, the person who won the bidding war. One is the person who lost the bidding war. Which one of these lines do you think goes with the winner? It gives you an index up there, but it's almost unreadable. So the winner is this stock. The loser is this stock. In a bit, if you are a shareholder in a company in a bidding war, get down and you say, please God, let them lose. Because if you win, you won for a reason. Everybody else thought you were paying too much, and guess most of the time they're right. It's yes. You could, but you'd have to know before. You mean after the fact? You could, but you're not going to make a whole lot of money. These graphs always exaggerate. So you're talking about plus 1.5%, minus 1.5%. If it plus 15 or minus 15, I would go for it. Right? Yes, Andrew.
Moving the lots.
It is not making the big mistake, right? That's what you do. So it's like getting on eBay. You start bidding on something, you forget what you actually came in to pay. And before you know it, you're at $800. You think, but why would people not drop out? Because at this point, what have you defined winning success as? Winning the bidding war. And CEOs, I used to think it was the macho effect, right? But there's a very simple test of whether it's a macho effect, which a female CEO shouldn't be much more. It turns out that there's nothing to do with whether you're male or female. The testosterone seems to be fed into you, no matter what you come into the CEO thing already like, Arnold Schwarzenegger, pumped up. You can't lose. I'm in a bidding war. I have to win at any cost. This graph actually looks at two things. One is small versus large targets. So the way they measure targets is the size of the target relative to the size of the acquiring company. So the blue are the smallest targets and the purple are the largest targets. And it looks at all cash, all stock, combo. Let's start with across all types of payments. It's a no-brainer. Small targets, you get this little win, but large targets, you lose a large amount. So small versus large. But the cash versus stock is interesting. For really small deals, it turns out that cash is better. For really really small deals, basically as you look across from small to large, for at least with all cash deals, if you're doing a really small deal, if you use cash, you're at a penalty. But with really large deals, if you use stock, it becomes a problem. And think of why. You're a large target company. I'm a large acquiring company. I tell you I'm going to pay with stock. Why do I pay with stock? Because I think my stock is overvalued. So when I tell you I'm paying with stock, what do? You start to say, I asked you for a 20% premium. I've changed my mind. I'd like a 35% premium. It turns out that the premium adjusts. There's game theory going on, which is I look at what you do and I adjust what I demand accordingly. And finally, if you look at private versus public, and I'm going to introduce a third player here, which is divisions of public companies that get sold off. The results, again, are very clear. Across the board, targeting public companies is your worst possible strategy. But across the board, targeting divisions of public companies. So private is better than public, but divisions of public companies that are being sold are even better than going after private targets. Why do you think that is? Remember that graph with the table I showed you and I said, which division, think of how quickly you jumped in. Sell division D, terrible business. You got a lot of strategists around you. What do they say? Sell your bad business. And the problem with strategies, they never think about the price at which you sell, right? Bad business, off your books, you're better off. Not necessarily. In 2009, Ford owned Jaguar Land Rover. And 2009 was a bad year and the new CEO had come in a couple of years and he wanted to get rid of the bad. Jaguar Land Rover was a bad part of it, wasn't doing well. So you can almost see the edict from above saying, get rid of Jaguar Land Rover. And he said, at what price? It doesn't matter, give it away. And you took their advice, you gave it away. In fact, the company that bought Jaguar Land Rover was Tata Motors. They got it for pennies on the dollar. So as you look across acquisitions, you can see the odds shift. There are growth synergies, and basically there's a McKinsey study that looked at what percentage of the time do companies actually deliver on their promises. Growth, you can see it's almost like a uniform distribution. only 17 out of the 77 companies actually delivered 100% or more of the growth synergies. The rest delivered less. Cost synergies, not perfect, but a much higher percentage are able to deliver. Again, perhaps because they can plan on it and hold people accountable. So if you were to summarize the odds of success, studies show that, and I think this, small versus large, private versus public, the cash versus stock, you got to make the judgment based on what you're buying, and cost synergies over growth synergies. So let's draw the final lesson on acquisitions. You can win at the acquisition game if you stay disciplined, and it's really difficult to do. So if you have to, you cannot change and adapt your strategy just because you become bigger. But it does mean that acquisition-driven strategies come with the time limit. There's a point at which they will not work for you anymore, and you have to recognize when to stop. Now, Cisco became one of the most successful companies in the world entirely with acquisitions all the way through the 1990s. Harvard wrote a case study about how you can become a great company through acquisitions. And this is usually a kiss of death. Harvard targets you and say, you're a great company. This is the end for you. It's almost, they got it almost perfect. I think the case came out in 1999. And for the next decade, Cisco destroyed about 100 billion in value through acquisitions. So it's easy to see what you need to succeed in acquisitions. But the problems you're facing are behavioral, psychology, and those are things that you can't take out of the equation, but they're a heart of so much that goes wrong with acquisitions. But I do think we can bring in better acquisitions by holding people accountable. And those people include not just the top management that do the acquisitions, but entire ecosystems, the bankers, the consultants. I would propose that when you have banking deal fees, that half of the fees be withheld for 5 years after the deal. So I can see actually whether your numbers, maybe it should be tied to how closely the actual numbers come into your forecast. And if they don't, you know what? I'll withhold the remaining half. You're saying, but no banker will work for me. What have you lost? Other than the people who work at the bank who might lose their jobs, which might be you guys, but it's from the company's perspective, worrying that no banker will do a deal for you is like, it might be a good thing for you that no banker will do a deal for you. So let's set up value enhancement. So now we're going to talk about how do I change the value? I'm going to draw a contrast between enhancing value and enhancing price. By now, the value versus price obsession I have. But to show you the contrast between value and price enhancement, I'm going to show you the results of 2 studies. The first study was done in the late 90s. And I think the title of the study was A Rose by Any Other Name. And what they did was they looked at 64 companies that changed their names. You see, what's a big deal? Companies change their names. You know what they did to their names? They added .com to their names. Didn't change a thing about the business. What's the effect of adding .com to your name? I think in the spreadsheet, doesn't it ask you, do you have a .com? And then no, it doesn't, because it doesn't change your revenue growth, your margins. But you know what the effect was? These were small companies. You add .com, your stock price jumped 150%. You see, we've been wasting our time talking about cash flows, growth, and risk. This entire class should be about naming conventions and names that work and names that don't. But before you get too tempted to rename your company, I'm going to show you the results of a second study that happened 5 years later about companies that changed their names. You know what these companies did? They took .com out of their names and their price jumped. Why? Because 1999, peak of the .com boom, .com was a good thing. 5 years later, it was a sign of a doomed business. If you tried to keep markets happy by doing what they want, what makes them, it's like being with markets are bipolar, right? Manic, I like you, next minute, what the heck are you doing, right? So I'm not interested because I have no idea how to enhance price. But I'll have to tell you, most CEOs, when they talk about value enhancement, are really talking about price enhancement. Tell me how I can increase the price so I can collect my bonus, cash out my options. But true value enhancement has to show up somewhere in the numbers, right? There are 4 places you can go to enhance value. First is you can try to increase your cash flows from existing assets. We'll talk about ways you can do that. The second is you can try to increase the value from growth by either growing faster if you're in a good business or growing slower if you're in a bad business. Kind of cuts against the grain because your higher growth is good. Now, but that's not true. Third is you can try to lengthen the time you can earn more than your cost of capital, which is just a fancy way of saying build up your competitive advantages, barriers to entry. And the fourth is you can try to reduce your cost of capital. So in 4 slides, I'm going to capture pretty much everything you see in every restructure. Let's start with the cash flows. You come into a company, you say, how do I increase my cash flows from existing assets? First thing you hear in most restructuring is cost cutting, more efficient operations. Assuming you mean what you say, what I hear is higher margins. Second stop, if you have businesses that are losing money that you think will lose money forever, this is not just bad business. These are money losing businesses. Shut them down. You think, why wouldn't somebody have done it already? I'm a Yankee fan. Yesterday I was watching the game. I wish I had. And Giancarlo Stanton came to the 4 times. He struck out 3 times, and the 4th time he hit into a double play. I wish he'd struck out in this time too. You know, if you have no idea what I'm talking about, it's because it's an inside baseball thing. And my reaction was, why do you keep bringing him up? And the answer is Brian Cashman, who's the manager of the Yankees, was the person who signed Stanton. And if he says we're going to sit him down or cut him free, that's the admission of I screwed up. Nobody likes to admit. So when you have a CEO made this investment, it's losing money. You know, this is why when you see business shutdowns, almost always when a new CEO comes in. Because when you're a new CEO, you're so quick to admit to all of the previous guy's mistakes. You clear them off the table. Why? Because you want to make your own mistakes. Okay? Third, what I'm going to say next is going to sound mildly unpatriotic, so don't report me to the speech police. I've never believed that it should be the objective of any company to pay the most taxes you can. Bernie Sanders might disagree with me, but you know what? Within the framework of the law, you want to get away with paying as little in taxes as you can. So you can call me a moral troglodyte for doing that, but that's what businesses do. And there are ways in which you can legally, so again, notice how I'm covering legally. I'm not talking about tax evasion or even tax avoidance. I'm talking about tax management. I'm going to find a way to pay less in taxes. By doing what? If I'm a multinational, I want to move my income from my high tax locales to my low tax locales. If you look at any European multinational, notice that take a look at the margins in the different countries. I can almost promise you that the Irish sub will always have the highest margins. This might be true, complete coincidence that they happen to have the lowest corporate tax rate. Or it might be that you're moving things. I say, how do I move things around? Now, do any of your friends work in transfer pricing? But they're very boring people. But you know what transfer pricing is, right? Within companies, you often have transactions across divisions. So they're the ones who set the price because there's actually no transaction happening. They have to make up a price. Saying what drives that pricing? Very simply, you want to move things from Germany to Ireland. So your German sub sells the Irish sub, you put a high price, there's the income movement. So if you can lower the taxes, you go for it. In fact, even risk management, one of the few payoffs from risk management is you smooth out income pressure. So less in taxes, higher after-tax operating. If you've over-invested in the past, just stop for a moment, right? You're at 50% excess capacity. Why do you keep having to build new factories? Now, if you're valuing a cruise line company now, and you're putting a sales to cap ratio where they're buying new cruise ships, just stop, right? They're still trying to get back to where they were before 2020. There are more than enough ships. If you have excess capacity, you can stop CapEx for a while, not permanently, and then eventually have to come back. And if you have working capital as a big drain on your cash flows, managing working capital better can do amazing things to your cash flows. Before Walmart came along, the conventional rule in accounting was a healthy current ratio is 2 to 1, $2 of current assets, which basically means that every company had to have a positive working capital, and that was a good thing. And Walmart came along and said, who made up this crap? Why does current, and they said, we're going to try to make current assets equal to current liabilities. And the way they did this was they were one of the first ones to have just-in-time inventory, where people went around and made sure didn't have inventory build up. And they succeeded. They actually made working capital in neutral item. You see, who cares? That going from a current ratio of 2 to a current ratio of 1 generated about $2 billion in additional cash flows for Walmart every single year. So if you can generate more cash flows, go for it. Second stop, you have growth. And you're saying, well, I want to grow. Then you're a low value company. You're a new CEO. You surround yourself with strategy people. They give you ideas on how you can grow faster. And it's true that if you're in a good business, not reinvesting enough, reinvesting more will increase your growth rate and increase your value because you're earning more than your cost of capital. So if you're in a business where you earn more than your cost of capital, you can reinvest more, get a higher growth rate by either taking internal projects or maybe you can do sensible acquisitions. But are there companies where lowering the growth can increase value? Yeah. Andrew, what kind of companies? We're in a bad business, right? There, I'm going to push you to lower growth rate, reinvest less. And it's kind of backed up when you look at the different ways of growing. And this is a McKinsey study that ranked different growth strategies. One of the great advantages McKinsey has is they have a proprietary database of all the clients. I mean, there are clients who've used McKinsey for 60, 70 years of what those clients tried and how they paid off. So I'll go from best to worst. Best growth strategy, according to McKinsey's history, is to come up with a new product. Apple coming up with the first iPhone. You know, Microsoft with Azure as the first cloud product. In terms of every $1 million invested in that creates about $1.75 to $2 million in additional value. You're saying, why doesn't every company go for new products? It works sometimes, it doesn't work in other businesses. That's bad. Second best is expanding an existing market by either finding new users for your product. Novo Nordisk didn't go out and make, Wegovy and Ozempic saying, we want to make them weight loss drugs. They were diabetes drugs, which happened to have this, at least for Novo Nordisk, this pleasant side effect of people, while they were trying to fight diabetes, were losing 50 pounds. This is amazing. And now, if you look at Novo Nordisk, they get 60% of value from 2 drugs that accidentally happened to have become weight loss drugs. Third best strategy, maintaining or growing a share in a growing market. Because the market is growing, you get more slack, right? You can stay on without lowering prices. And then you get to the bottom of the barrel. The 2 worst strategies for growth is competing for share in a stable market. You see why? How do you get a higher market share in a stable market? And how do you take it from others? What do you have to do? You've got to cut prices. You cut prices. Try this out in your company. Increase your growth rate by 2%. Lower your margin by 2%. Look at what happens to your value per share. I will wager for every one of your companies, your value per share will go down. And the worst, and this shouldn't come as a surprise after I've been dumping on it for the last session and a half, is to do acquisitions. And just to give you perspective on this value creation versus growth, at the start of every year, I take every publicly traded company in the world, I compute the return on capital and the cost of capital, and look at what percentage of companies earn more than the cost of capital and what percent of companies earn less. And I broke it down regionally. So whatever part of the world you're in, you can check every part of the world. This is true. There are more companies that earn less than their cost of capital than there are companies that earn more than their cost of capital. 70% of global companies earn less than the cost of capital. And what did Andrew say about when growth creates value? You got to earn more than your cost of capital. So when I hear a company say, I want to grow faster, my reaction is maybe I should run for the exit doors now, because this is not always a good thing. Third stop, is there something you can do to lengthen your growth period? And this is all about creating barriers to entry. I am not a strategist, and you know that by now. But I think this is the only reason strategy classes exist, is to lengthen my growth period. And I'm going to list out 4 possible competitive advantages. First is brand name. Remember, we talked about brand name. It gives you pricing power. If you have it, preserve it. If you don't have it, you can try to create it, work on it. The second is legal protection. Wouldn't it be nice if the government stepped in and kept the competition out? Does it do that? Sometimes we've actually valued companies where that's, isn't that what you get with a patent? Yeah. But there are cases where the government actually physically keeps the competition out. For a century, the last century in the US, phone companies and utilities were regulated monopolies. What does that mean? The government actually said, you and only you can provide phone service. This is amazing, right? You're a monopoly. But be careful what you wish for. What does the word regulated come with there? No, what's a great thing? Think like a monopolist. For a moment, think you're John D. Rockefeller, right? What's a great thing about being a monopolist? First, everybody hates you, right? But how do you get back them? You charge them a 20% higher price. It makes you feel a lot better. You hate me, 20% higher. You hate me, still another 25%. The problem with being a regulated monopoly is when Con Ed wants to raise rates, what does it have to do? It has to go in front of a regulatory commission and beg them, like 3%, please, 3%. No, slightly higher than the inflation rate. The regulator, no, you know what? We have a lot of voters who don't like, we'll give you 2%. It's the worst of both worlds. Everybody still hates you because you're a phone company to charge 3% more. I would be so frustrated as the CEO of a phone company. Okay. So that's legal protection. Switching costs. You know what switching cost is? Basically, you want to make the cost of switching into your product as low as possible. And once people switch in, you want to make the cost of switching out as high as possible. I have AT&T, and I've got to run past the Verizon store, whatever, because it's almost like they all know I have AT&T. They all gather in the door. Come on in. We can switch you to Verizon in 5 minutes. And they will. You go in, switch to Verizon in 5 minutes. They'll give you this 24-page document to sign. Who has first, the font is so small, I can't even read it. You sign it. They've got you hooked. You try to get out, said, no, you're for 24 months. What do I have to do to leave? Your firstborn, maybe your house, the title to your house, all your voicemails, we will keep them for eternity. We won't let you. I don't blame them, right? Because otherwise I'll be switching AT&T to Verizon, Verizon to T-Mobile, back and forth. It's a commodity. Switching costs. And finally, if you have a cost advantage over everybody else, it's great, right? Now, where does the cost advantage come from? Most of the time, it's in doubt. Why does Aramco have a cost advantage? Because the Saudi government decided 300 million barrels of oil under the Saudi sands, it's all yours. But there are times when companies earn a cost advantage by putting in resources in. The Templeton funds were in Asia about 10 years before everybody else. And they had a cost advantage for a while because they had the data, they had the resources, they had the people on the ground. That's gone now. One last page and we'll be done. You want a lower cost of capital, right? And your first reaction is that change the mix of debt and equity, which is one. But here are 3 other ways you can lower your cost of capital that generally we don't talk about much. If you got mismatched debt, you know what I mean by that? Short-term debt funding, long-term assets. Yuan debt funding, dollar assets. Just stop. Mismatching increases default risk. Matching it up reduces default risk. Basically lowers your cost of capital. And there are 2 things we talk about in the context of betas. If you have a discretionary product or service, I said you have a higher beta, right? If you can try to make your product or service less discretionary, your beta goes down. The other day I was in the subway, the guy in front of me dropped his phone and it broke. He was heartbroken. He said, my name, my life, my calendar is I am completely, my guess is this guy went into a mental asylum right after that, right? Let's face it. Self-service has become non-discretionary. You probably said, look, I can live without food, but I can't live without my cell phone. And secondly, if you have a lot of fixed costs, push it up if you can find a way to make your cost structure more flexible. So I will leave you with that page because on Monday, after I've given you the results, I'm going to talk about how we're going to use these ways of changing value to value control. Right? You can see essentially the next step in the process. But that will be in the last half of the last class. So I will see you on Monday. And I know what you're going to be doing between now and Monday. So I will try to keep my intrusions as minimal as possible. But I will talk to you on Monday.
Hi, Professor. Quick question. So for our final deliverable, where do we submit our regressions for our pricing?
You don't submit the regression. That's the final output from the regression.
Okay.
The equation with the T statistics and the R square.
So where do we submit that? We put it on the write-up?
Basically, the regression output itself is.
Or so we leave it as one of the sheets?
You can either take it as a picture of just, because it's not a whole sheet. I mean,
Right, yeah.
No, I don't care about all the other stuff. It's basically the coefficient of this, because you can take a picture of that, paste it right in.
In our write-up, we'll write up for
You
submitting.
don't keep it separate, because it doesn't, it's better to try it in there, right? So when you talk about using the market.
Yeah. But you don't need the